And welcome to our 2024 Rating Agency Summer Update. I'm Jim Lenman in Kaufman Hall's Thought Leadership Group, and I have just a couple of items to note before we begin the webinar. First, we encourage you to ask questions throughout the webinar using the Q&A function on the webinar platform. We will get to as many of your questions as time permits during the hour. Second, we are recording this webinar and will share a link with you in an email within the next day or two. Moderating today's webinar are Robert Turner, a Managing Director and leader of our Treasury and Capital Markets practice, and Lisa Goldstein, also a Managing Director in our Treasury and Capital Markets practice. Joining Robert and Lisa today are Eva Bogarty, Associate Managing Director at Moody's, Susie Desai, Senior Director at S&P Global Ratings, and Kevin Holleran, Senior Director at Fitch Ratings. We thank our panelists for taking the time to share their insights with us today. And before I turn the webinar over to Robert and Lisa, I'd like to remind everyone that today's panelists will be reconvening at our Healthcare Leadership Conference in Chicago on Thursday, October 24th. Registration for the conference is now open, and you can find the link on the homepage of the Kaufman Hall website. And with that, I'll turn the webinar over to Robert and Lisa.
Thanks, Jim. I want to thank everyone for joining us today, including our panelists. This is the summer installment. Hopefully an umbrella drink is in your recent past or near future, but we're excited today to get into another round of questions with our panelists, so thank you, everybody. I think we'll start by talking about strategy, and maybe Eva, we'll go to you first. I think the question we'll start with is, are you seeing a return to sort of bigger picture strategic planning? And if so, sort of what are the key factors that are shaping strategic decisions?
Yeah, thank you. And thanks for having me today. Great to be here as always. Yeah, absolutely a return to long-term planning that I'm sure we're all rejoicing in, including hospital systems. You know, it's nice to get our heads up out of crisis and triage and be thinking long-term and you know, I think there were some hard lessons learned in the last several years, and that's also helping to inform long-term planning. I think we're seeing a lot of, you know, which we also think is great, you know, combining long-term planning with multi-year projections, really a focus on ROI. I think that's, you know, always been a focus, but coming out of the last several years, like, and still having not return to pre-pandemic cash flow, folks are really focused on, you know, what's going to bring the best ROI in the near term, and focusing capital on that, I think is one common theme we are seeing. And, you know, a lot of kind of deep diving into understanding dependencies and vulnerabilities and conversations around that. And that's something that we, you know, we're always saying we want to hear the story, right? And hear the big picture. Everybody's strategy is not going to be the same. A successful strategy is not the same for each hospital or system. So, you know, really hearing those stories is a helpful thing. And I think, I guess I would say, I'm curious what Susie and Kevin say, but we're still seeing, you know, not everyone is wholly there on IT integration. And I think that is still a focus and a conversation on the strategic planning side. And I think a lot of systems learned through this crisis how important having all of that, you know, dialed in and that access to data is has been. So, you know, yeah, seeing that's kind of my big picture.
I think we would say, you know, on that line, I think we're seeing the same things. I do think that and we were talking about this briefly before, where the organization is operationally. I think the strategy is there, but where the emphasis in our discussions during conversations or during our meetings, if there's a lot of operating pressure, we still have a lot of discussion on how are we turning things around to help sustain that longer term strategy. So then maybe the balance shifts a little bit, but I would say with stepping back, there is a lot more conversation about strategy and long-term strategy, but I know for some, there's still a lot of operating focus too.
Yeah.
And I would agree with the IT. I think that's it kind of goes into some of the different strategies that we're now seeing kind of coming out of the pandemic too. So we can talk more about that as well. Yeah. I don't know, Kevin, if you want to
I echo everything you guys said. Absolutely.
Yeah, I think it's interesting what you said, Susie, the performance improvement, like seeing the long-term plans come out of that performance improvement and, how that has focused, where we know we're not where we need to be in performance, and we can see now that this is the area we need to go. Whereas before it might have been over here, it might have been the tower build, and now it's the ambulatory, focus, and probably it always has been for a
Right.
long time, but it's much more focused, I would say.
So
Yeah.
I'm curious. So for organizations that maybe have turned a corner and if we're seeing a return to profitability, where they've maybe been very tactical about focusing on, very specific elements of improvement, do you see them sort of zooming out and thinking a little more broadly about enterprise strategy? Is that sort of now fair game again? I'm curious to get the group's thoughts.
I think absolutely. I mean, I think for those that have turned the corner or see the light, see that pathway, I think those strategies I think they are more focused. I don't think they've thrown out their I don't think, who they, like I think Eva was saying earlier, who that organization is and what they want to do. I don't know if that's fundamentally changed. I think there's still the core of who they are. I think what we're hearing from the strategies is that they're fine tuning them. They may be sort of pushing some things that are on the peripheral edge out, or maybe doing it as a partnership, but really kind of honing in, like we're a research academic institution. How do we kind of accelerate that? I think the IT is a really important strategy in terms of, pulling it all together. I think there's still a lot about growth and diversification, but in light of who that organization is. So I don't think we've seen strategic plans being totally thrown out, but I think technology's accelerated things and made it important that you have to have that all lined up for operational kind of success.
Well, and also like competitive advantage is so important. I see folks playing on that in a very like specific way, right? To your point, AMC's growing tertiary, quaternary, increasing service areas. I think that is, really honed in on competitive advantages.
I think a part of it too is, we always talk about, what do you want to be when you grow up, and we do focus a lot on growth. But I also think when we're coming past COVID, we went through, labor demic, margins are a little tighter. Every dollar is a little bit more precious than it used to be. I think you're also seeing a little bit of we can't be all things to all people at all times. And if something isn't in our core competency, either how do we partner with it, get it off our books, or maybe we exit that particular service line, market area, site, anything along those lines, and say, let's focus on what we do and what we do best. We don't have to be the next big X, Y, or Z in our market.
Yeah, a lot more joint ventures and partnerships, and even, the M&A is sort of kicking up a little bit more. And I think one of the things, there's a lot of different reasons for that, but I know we've heard, to Kevin's point, like being really important to a service area, right? It's not just a smaller service area. We're seeing M&A where we want to be important to this region or this state. And that's for we're seeing some of the M&A as well and some of the focus. But I agree with some of the divestitures too, that if we can't be there and we're not, maybe give it to another partner or another organization that can put the resources there, and then we can sort of focus our resources on this particular area.
Yeah, I think that like regionality, that like leverage of being, dominating a region is a bigger focus for M&A often than just sheer size in these days.
Yep. Density. Yeah.
Yeah, so it's almost like you can't be all things to all people. So find partners that will let you be compelling on a joint basis, right? Mm-hmm. And so lots of discussion about different sort of models, right? JOAs, joint ventures, et cetera. How do you sort of leverage the best parts of multiple systems? Is that something you're seeing? Maybe Kevin first and then the others.
No, I think that's spot on. And the old phrase, go big or go home. I think it's just go dense or go home kind of a thing. Yeah. Again, focus on what you can do. And if you find you can't do it, or you find you're chasing something that's not working. So if you're number 3 or number 4 in a service line or a market, how much more money do you put into that to be number 2? particularly if it doesn't have a contribution margin. Maybe I partner with someone. I think we see a lot of that, certainly with behavioral health is a very frequent partner. Ambulatory surgery is another very frequent partner that we see, certainly, syndicating with their own physicians. I think it really is taking a harder look at, what are our assets? What do we have? What do we want to be? And again, I'm going to get back to it again. I think sometimes it's not, I've got to be huge, but I do need to be dense. I've got to be meaningful in that market. As we all know, look, the negotiations with the payers, that's the key. And I think my colleagues would agree with me. Most people we're talking to, if they're in trouble, it's still, financial trouble. It's not a volume problem, right? It's an expense problem. Like, can't do a whole lot with some expenses. So much of that is sort of locked in. It's labor, it's salary. So I need more reimbursement, and the way to get reimbursement is to use your density. And we always say size and scale, but I prefer density, quite frankly, and leverage that with the payers to say, hey, look, we need better bumps than we've gotten in the past. And so I think you're really seeing a more focus on that, quite frankly.
Yeah, and I think, absolutely seeing like the unwinding of longstanding JOAs, right? We're reading about them, and,
Yes.
that's definitely a trend that's happening.
And exiting of Medicare Advantage is something else. I mean, they were the darling child 4 or 5 years ago, and now it seems like every phone call, we're getting out, we can't get out fast enough, that sort of thing. So we're dismantling things that maybe we're finding we're not working.
And Kevin, how does?
Oh, sorry, go ahead. Yeah,
I was just going to say, dismantling Medicare Advantage contracts, that has been a strategy we've seen. How does that go over in rating committee? What are the viewed risks of that and advantages of it?
Not as shocking as you might think from a risk standpoint. I mean, quite frankly, the stories that we generally hear when someone's exiting an MA is, look, it's costing me a lot of money. So you get basically addition by subtraction, helps that bottom line, helps that margin. So we're never going to say that's bad. We think that's good, right? Improving the bottom line and margin. I think what I hear the most time is, look, that really is it's a risk-based business. We got into it. We thought we could do better at it yet. Maybe we're not quite ready for it yet. Maybe we're not that whole continuum of care we hope to be. And frankly, we prefer the other kind of business. We prefer more of that fee for service. We excel there, if you will. So I don't think we view it negatively at all. We think it, again, is focusing on your core strengths and being able to shore up your bottom line, again, with every dollar just a little bit more precious. It's not seen negatively at all.
And sometimes we'll ask, like, how are you thinking about the patients in that perspective and the volume, taking care of those patients in that different format? So they've usually thought through a lot of the risks there and how they're kind of offsetting it. So we tend to ask, okay, if you might lose that business, and you may not lose it all, right? What next?
Right.
Yeah, and I think it's the rare committee or the rare instance where it results in a downgrade because there was, some, seismic shift in cash or cash flow, and it's difficult to, and you may have, like, maybe you're not exiting fully, but you're going out of network for a while and the rebuild goes awry, so that's, unfortunately a rare occurrence.
So
do you?
Yeah, go ahead. No, Lisa, go ahead.
You talked about no longer being all things to all people. Do you get the sense that organizations struggle or boards struggle with closing a service where, Kevin, like you said, you don't have that density like obstetrics? And if you create a medical desert, right, people have to travel even further. Do you see organizations really debate and discuss, our mission here versus a financial reality?
Absolutely. I think we've been seeing this for the last several years, and we refer to it a lot of times, that mission versus margin discussion.
Yep.
And look, we deal with not-for-profits. A whole lot of them, obviously, are religious-based organizations that we deal with. And I think there's this inherent sense that if I close a service, maybe it's OB, maybe it's PEDS, maybe it's behavioral, I'm letting my community down. And we have a hard time, if you will, closing things. We're builders. We like to grow. We like to expand. We like to bring our level of care and take care of a community. And we have a very hard time sort of letting go. But the reality is, the old anecdote, no margin, no mission. You have to take that really hard look and say, again, how much do I want to spend from an organizational perspective on a service line or a couple of service lines that might not be working too well for you, and preserve the whole and the whole mission, if you will. So yeah, I think it's a very tough decision and a very big decision that takes place, and we probably don't make as a whole decisions fast enough in it, and we probably let it peter out a little bit too long before we finally make the decision it's time to close that down or get out of this, or exit a hospital or exit a market, so to speak. So it's a very difficult decision for healthcare in general.
Yeah,
the
and I
current
know.
Oh, go ahead, Eva.
Oh, I was just going to say, press is not kind about it. It's not we're not like Madonna where there's no bad press.
Yep. And I think, again, that's us, we worry about that all the time. We self-internalize it, I think, as a sector, like, oh my goodness, we get bad press, I've let down the community. But I submit to you that probably the average consumer is not really keyed into the bigger picture thing. And if this service line or that service line closes, they're probably not paying that close of attention to it. It's just what's in for my needs. My God, you close orthopedics and I've got orthopedic problems, then you clued into it. But if you close peds and you have no kids, you're not paying any attention to it. So I think we internalize it probably a little bit more than we maybe need to, more that's healthy.
And I think we've seen like that. Sorry, I was going to say, we've seen partnerships with like FQHCs, like when they're closing something or moving in. So I think the hospitals, the non-for-profit community does sort of figure out, it's not just we're closing and good luck. They try to figure out a plan to kind of get these services still to the patients, and thinking about where the organization's located, that maybe you can shift. It's a 3-mile drive instead of a 2-mile drive to get to that. So I think messaging that, I think, has been done, has been, at least organizations have tried to do.
Yeah. Maybe we talk about introducing new service lines for a minute, because we're talking about sort of what it would mean to curtail services, but if we're thinking about sort of what to introduce into a market, what do you want for management, right? So what sort of analysis do you like to see, and sort of how does materiality play into that? Maybe Susie, you could talk to that.
Yeah, I think it's like when you're starting any new strategy or any new thing, right? Like, what's the investment? What do you feel like are the risks, and where do you have the strengths that you're going after this new thing, whatever it might be? And, we've seen some big strategies where, it does go in the wrong direction. So I think understanding capital investments, the guardrails, how much, this is a new strategy, but, it's 5% of our revenues. It's, we've kind of put the guardrails that we could lose this much. We don't think we're going to lose it. So understanding that, and again, the competency that the organization has to execute on it. And of course the why, and how this fits into the overall picture of the organization and where it wants to be, or some of the things that we would ask questions about.
Gotcha.
Yeah. Not to be too business schooly, but like the SWOT analysis, right? Just,
right. It's a thing.
That?
Yeah.
Who doesn't love it? Who doesn't love a good SWOT analysis? Come
right.
Yeah.
So a question on timing, right? So investments take time to bear results. What's the shot clock, right, for trying new strategies? How long do you need before you need to see the results start to bear fruit? And I know that's a very generic question, but maybe just help us think through how you would approach this. Maybe Kevin.
Yeah, I think you're sort of asking like, hey, if I'm about to do something and it's big, and by big it may have some performance indications or liquidity indications, are you going to downgrade me? I think that's kind of what we're cut to the chase there. I would say, generally speaking, that's probably a hard no, that we won't downgrade you. So there's always a hook, right? What's the caveat? You do need a balance sheet that's going to sustain you during this transition or launch or whatever you want to call it. And it really helps if you have a good track record of success doing, some big change. And I'd say, look, not a lot of people have long track records of big change, because a lot of us don't do big change, so to speak. So there's usually a limited track record, but certainly if you've got one, that's something we hang our hat on and say they've done this before, they've seen it before, not a problem. I tell people a lot of times, look, I'm a sucker for a good strategy, and so, but I think Susie was saying, look, I want you to measure twice, 3 times, and cut once. Be very sure about this thing, and kind of the old explorer mentality. Once you get to the newfound land, you burn the ships behind you to get commitment. I completely agree with that as an internal message, if you will, that we're doing this and we're going to make it happen. But if it's a big enough strategy, having an off ramp or a couple of off ramps is not a bad idea as well too. So I think, look, as long as you got a balance sheet with some flexibility, a little bit of cushion, give you a chance to recover if things go sideways a little bit, as we just discussed. We're not going to have a knee-jerk reaction on the next big thing or a new strategy. We'll probably go along for the ride, see what happens.
Yeah, I guess I would. Oh, Susie, you go first, and I'll.
I was going to say I would agree with that. I think generally speaking, if it's sort of in a certain range, I do think there have been historically some bigger strategies that involved a lot of debt. It just wasn't enough, and there's just too much risk, and so there are times where we might, if it's if it's more of a, it's not a curve, but it's a hard right or something, it might have some rating implications. So, and it has in the past, but generally speaking, if it's in a range, we can, and again, like what Kevin said, depending on the balance sheet strength, and kind of what the operating cash flows also look like.
I know you're not.
Yeah, and I mean, oh, sorry. If I
No,
could just, if like a management and board's risk reward threshold should be different from a rating agency's risk reward threshold, right? These two things, to me, take a rating hit for an awesome strategy. If that's, like, don't do everything just for the rating, I think is what I would say. I agree with Kevin and Susie on how they, characterized if it would be a downgrade. And then as I would just say, as it's going along, those, off ramps, if it did take a turn that you didn't expect, communicate and tell us why and what you're doing and how you're dealing with it, regularly. That is, certainly very helpful.
Yeah. No, you're not sort of in the business of giving advice, but I mean, do you sometimes run into sort of strategies that you think, wow, I'm not sure I would do that? And if so, how do you manage that?
I would say we write, the risky strategy, like our credit opinion is going to tell you that we view this different than the management team does. Management expects blah, blah, blah. We view this as a risk because of blah, blah, blah. It's not advice. It's just our opinion is different.
Yeah.
Yeah, we manage it very carefully in the report.
Yes.
There's a lot of bond speak language in there, but I remember years ago we were working with somebody that had no medical malpractice insurance, and they were like, well, we've never been sued before, so we just figured if we have like a bunch of medical malpractice insurance, we'll get sued for that dollar amount. Thought, what a risky strategy. I've never heard of anyone doing that before, and we just danced around a little bit saying unique to the industry and never seen this before and stuff like that. But
Yeah.
But it's hard to say it hasn't worked and it's a bad idea, because so far for them it did all right. But we're very careful to sort of dance around those things just a little bit.
Yeah.
Lisa, do you want to walk us through some of a conversation about some other covenants and performance issues?
Yes, I'm happy to. This has been a great discussion. You'll recall at our last webinar, the topic du jour was Change Healthcare. And that was coming off the heels of the February 21st cyber attack. So bringing us forward from that conversation to today, if you look back, did any of you have any rating downgrades attributable to Change Healthcare? Why or why not? Anyone?
No.
Go ahead. Susie, go ahead. No. Okay.
No, we did not. I think there may be some noise still kind of floating through on AR and things like that, but we have not had any rating or outlook changes because of that.
Okay. That's good
Same.
to know.
There were a few folks that got a little close on liquidity, but they took advantage of the liquidity that was available to them, tided them over, so to speak. And I agree with Susie. There might be some vestiges out there we're unaware of, but no direct rating action at all. Just a lot of management time and energy and focus spent on this, quite frankly.
Yeah, agree.
Okay. So from everything we learned about Change Healthcare, what do you want to see in presentations regarding cybersecurity? Eva, do you want to start?
Yeah, tell us your strategy. Tell us what
Mm,
you do. I mean, we don't need pages and pages on it. It is, falls under enterprise risk management. We want to hear how you reacted to change healthcare, maybe not just change healthcare
right.
specific, but did it make you see things at all differently? Are you doing anything differently because of it? What is your governance structure? And I'm not, it doesn't have to be 15 minutes. It's, it can be a pretty high level, um, you know, this is what we do, these are the tests we run, and, this is our staff. And yes, it is growing as a percent of our budget, IT budget, or no, it's not, but those just high level points.
Right.
Yep.
Susie, anything to add?
No, I think that's all fair information. And I think, Eva made the point earlier about IT, and when we have these mergers and things, I think there is that focus of getting everything together. And, I think, having that focus to streamline everything as quickly as possible. We're hearing that a little bit more. So we ask, like, what's your strategy if you are merging to make sure everything's kind of in place. But I think I'd agree with everything
Got it.
said.
Got it.
Yep.
Okay.
Same.
And Kevin, you mentioned liquidity. What are you looking for in terms of liquidity? Is there more of a focus now on daily liquidity, more than you've ever seen before coming out of the pandemic and cyber issues? Or is it still a broader perspective?
A little bit of both. I mean, so like, yeah, again, for the record, like we're not looking for anything in specific for liquidity.
Right,
It's kind of like, well,
right.
what do you want to be? A double A credit? You need 500 days cash on hand. You want to be single C? 5 would be sufficient. Just depends on what you want to do. Our median is going to come out like right around 220 days. I think, but to your point, I think given what we saw with change, is probably put a little bit more emphasis on maybe bolstering that just a little bit for that unintended thing that could happen to you that's completely out of your control, and having it a little bit more liquid. So I think, personally, I look at cash as is like a leverage metric. If you're too lightly levered, maybe you're not using your tax exempt status to its fullest advantage, and too much, maybe you're over levered. I think cash is kind of the same way. Too little, there's no cushion, right? Too much, maybe you're not deploying it appropriately is a question that could come up. Again, I can't give any advice, but I like our median, quite frankly. I've always thought, having 6 months is a really good place to be. That gives you access to the market in case something ever goes a little weird. 180 days, that's a nice little, kind of number. And like I say, our median's 200, 220, something along those lines. So it's a little bit extra. And I think that is a little more important these days after change. It's just a little bit, a little extra cushion just in case.
I think
So
we use the
yeah, go ahead.
CPM, so like we've seen a lot more access to those things just for the liquidity purposes. So, and I think it's funny, like I remember back at the 07, 08 crisis, there was a lot of like rejiggering the portfolio so that we had your sort of, this is what we need for like 3 months of cash, and here's what our longer term investments are for more strategic things. And so I think a lot of that has been put in place too, and maybe it's just amping it up a little bit, is what we're seeing after what's gone on over the last couple of years and with change.
Is there a point where you view, Susie, a draw on a line of credit as now permanent debt?
Yeah, it depends on like the situation, right? Like I know, we've had some healthcare systems that have, had various whatever issues, and they draw on their line because they don't want to liquidate their investments. And if we see it sort of come in and out, we get it. But if it sits there and it sits there for a year and it sits there, we in our analysis, we ask what's the intention, and a lot of times the intention is we're going to pay this off over and it, in the past it was a little quicker. I think nowadays it might be a little bit longer, and we will either like back it out of cash because just to kind of get the credit view of the organization, or if it's like, yeah, we thought we were going to pay it off, but it's turning into long, it's going to be a little bit longer. Well, then we may put it into debt if that's how they're thinking about it. Potentially it could go into long-term debt, and then we kind of get everything lined up. So we are either kind of pulling it out of your cash or, if it's there, just to kind of make sure we understand what the credit view is, or we're throwing it into debt.
Yeah, I think it's like the dependency on it is really what makes you focus on it as a, and decide where to put it, how to look at it.
And the frequency as well. So yeah,
Yeah.
I've worked with people. It's like we tap it all the time. We're paying it off, as we said, but we do it 3, 4, 5 times a year. Well, then it's kind of permanent debt at that stage of the game. It's always out there. So yeah, same basic method, I think.
So speaking of medians, it's getting to be median season, right? As we head into late summer, early fall. Let's shift to the income statement. So any preliminary view into operating margin or operating cash flow margin? Eva, do you want to start?
Sure, yeah. We track it quarterly, so we're very happy to see that for 3/31, that quarter ending, and that's year-to-date quarterly, so was 6.6%. So that's great. December was 6.1%. That's up, over, like, I think our low was 5.1% in the depths of it. So, definitely tracking, not yet at the 8.2% operating cash flow margin pre-pandemic, but trending up, so positive. Yeah.
And I could jump in as well too. Just focusing a little bit more on margin, slightly different one. So last median set, which was again 2022 full year, Fitch's operating margin meeting was 0.2%, and we thought when we ran our 2023s, when it's all said and done, it would bump up. It's bumped up just a little bit if these numbers hold. We're not completely done, but we're looking now about 0.4%. So it's double, but but it's not a lot. We were expecting a little bit higher as those 1231s came in. So we're probably looking again at not quite half our rated universe is got a negative operating margin. I agree that 2024 anecdotally is shaping up to be much better. We're seeing 331s, we're seeing 630s that are coming in. Very busy market, as everybody knows. We're having lots of discussions and seeing some, 531s and kind of different sets. And so far, the profitability generally across the board seems better. And then, of course, the question always becomes, well, is it sustainable? Does 3 months, 5 months, 6 months a trend make? And it does feel like it is sustainable. It's got some stickiness to it. All of the work we've been doing for the last several years really feels like it's having its traction now, and we're really starting to see some growth. So the medians are not going to show jubilation, I don't think, from a margin standpoint, but certainly 2024 is shaping up to be a little bit better.
Yeah, and I think we don't have I haven't seen the final, like the numbers yet that we'll be putting out here. I mean, when we ran our numbers in May, we had about half of our portfolio, so about 200 credits, and we were also running at about a 0% margin, so very similar to the prior year, so not much movement, not much improvement. I think similarly with this year, there is some improvement. I don't think everyone, still not back to where they want to be, but there's also some of that 340B settlement numbers kind of coming through. And so I think some of that was 2023, some of that's coming in early 2024. So I think it goes back to what Kevin said about sustainability and, because there's still a lot of headwinds out there. And certainly a lot of progress too, though, for on the expense side and on the rate side, but still things out there.
I think in 24, we're going to have a job to sort of tease out 340B, as Susie said, FEMA monies, so sort of these, what's the quality of the earning, quite frankly, and what's pure operation, and what's that as they say in Cajun, that lagniappe, that little extra. And I think that'll be something we're going to have to tease out in 24. But again, I think even baseline level looks better than it did in 23.
That's a question we receive frequently. Will the rating agencies adjust out my 340B, not settlement, but repayment? Or I finally got my check from FEMA, will they take it out of the P&L? So it sounds like, if I can translate, that you look at it both ways, as is and then without one time. Is that correct?
I think it's very fair that what we'll do at Fitch, we'll certainly let it ride through, but if it's a notable amount of your P&L, $100 million and 85 million of it is from the sort of one-time stuff, we'll definitely cite that and point that out to say, hey, look, on pure operations, it was just 15% or whatever the numbers are. So I think that's very fair, Lisa, yes.
Yeah.
Same.
We would do the same.
Are you seeing FEMA monies start to come through, or is it still, say, more of a trickle?
I feel like it's been a little bit of a trickle. Like it was, everyone, I thought in the spring that they were going to get it. I forget what the word is, but distributed out. And I haven't seen, although I haven't seen, these May numbers and June numbers yet, but I have not heard that it's been moving. I don't know if you guys, Kevin or Eva, if you've heard anything differently.
Nope.
I'd go with the trickle answer too. Yeah.
Yeah.
Yes.
Okay. Okay. And then the same question we're getting on some of the new supplemental state funding, DPP funds, et cetera. How does a rating committee view those? Eva, do you want to start?
Sure. Yeah. I mean, I think it's similar to the 340B and FEMA, right? These are, I mean, although these are recurring often, we want to know like the quality of your cash flow and performance, your earnings, and absent that, so what's going on without the DPP, and then layer on the DPP and see how that helps you, and it's not, and we want to hear about what the environment is. Is there, how recurring is this? How, what's the story with appropriations and, the details behind it for you.
I think states have been in a pretty good spot for the last few years. So I
Yeah.
think when there is some issue with states and they have to pull back, I don't think they'll pull back from the program entirely, but do you cut here and there, make some shifts, like make some changes? So I think that's what, I think rating agencies don't all your, eggs in one basket. So if all your income is coming from this, if a big chunk of your revenues are from this, it's just something that we keep an eye on and we view as a risk, but certainly been helpful from a cash flow perspective.
Yeah,
Right.
I'll jump in and say, look, I think, personally, we love the DPP programs. I mean, they can have meaningful impact on the P&L. And if it goes on for a few years, it can have real meaning impact on the balance sheet. And we've seen some credits go from, triple B category into the A category, like a notch upgrade every year, because just the funds coming through are so meaningful, so significant. And even if they are subject to annual approval or anything along those lines, I think, look, it's hard to pull back on those once you sort of unleash them. So I think we view them, kind of favorably and not disfavorably, and more like again, not to say 340B is a bad thing, right? It's a good thing, but it's truly more one time, this catch-up payment, than, a fundamental change, if you will, to a program that's allowing, finally more funds to flow through, quite frankly.
Yeah, I agree with that. I think they just come with a little bit of a warning label, right? It's like, okay, know your risks around this,
Right.
this fund, this, stream of revenue that you're depending on for.
And I think, if you're a big Medicaid, you're a safety net Medicaid, and it's like part of your, like it's helping. that's sort of kind of who you are and what you do too. And I think it may have different effects, kind of where you are on the rating scale too. But it has been certainly a beneficial program.
Yeah.
So I think about, Susie, general acute care hospitals that may not be a safety net, and the funds have started and they are becoming a bigger part of cash flow or the bottom line. So when you see a forward set of projections, and Eva, you may have touched on this, but do you want those funds identified, or is it just assumed to be a part of, say, net patient revenue that will likely, you're going to make a bet that it's going to continue?
I think we asked the assumption, but I think the assumption is that it's going to continue and it's sort of rolling through their numbers. At least that's but we'll ask the question, is that the organ, in most places, even if it's a 1-year renewal, it's likely to go on. So they have been putting that through. So we do ask, and we would like to, I think it is helpful to see it. And I think things like the 340B program and the discounts and getting those kinds of things would be helpful to see too. Just again, anything that's sort of really playing into your income, and if the program shifts, or again, there's just not that it's going to change materially, but something gets cut a little bit, what does it mean?
Yeah, I think it's helpful to see it. If you have it, include it. That's what I would say.
Got it.
Yeah.
And we just got to go ahead.
Yeah, putting like a goose egg there, you're almost positive funds are going to come in. So it's like you went from profitability to loss. but I've got 0 here. Like, give us something. What's the historic number? This is where local intelligence really plays a game. Is there expected pushback? If you expect it, tell us. Well, we got to put it in there. It's
Right.
it makes it very hard for us to do forward-looking projections on our own if we see 0 there and we know it's not going to be 0. So.
Right.
Yeah.
Let me actually run with that. And Eva, you mentioned this. What happens when you go to a rating committee and the borrower, the credit does not provide projections? How does that go over? Do you do your own? What's the expectation? COVID, the pandemic's over. Can you talk about that?
Yeah, I
Go
mean, we
ahead,
do
Eva.
our own.
Yeah.
We do our own, and we will share them with you. And especially if there's downward pressure or upward pressure, if you're pushing for an upgrade and we don't have projections, that is kind of a funny spot. Yeah, we will always do our own based on, as Kevin said, the local knowledge of the state and the funding environment and, any information we have and historic information, and just kind of project out. Yeah. But yeah, so it is part, like, I think it's a best practice.
Lisa, I think we all.
We would like it. Yeah, go ahead.
We can't hear you, Kevin.
Oh,
No,
Kevin, you may
I
want
think
me.
we all ask for
Good.
projections, and some people feel like they can't give them to us. I'm not on mute. Can you hear me?
Yeah, we can hear you now. Go ahead.
It's best practice to get them, obviously. Ah, fantastic. I promise I wasn't on mute. I really. We like to see them, right? And some people feel like they can't give them, they can't share them, they'll be held to a promise or something like that. So if someone won't give them to us or feel like they can't, well, at least ask them to give us a range or something along those lines, and that might help. I think spot on. We take what we get. We really do project our own as well too. But even a range, quite frankly, is helpful. What do you expect cash flow to be, margin to be, days cash on hand to grow to, that sort of thing over the next couple of years, and we can certainly work with that, understanding the sensitivity of projections.
Yeah, but it is, again, because you all know your the organizations know their strategies and know what's going to kick in when and what. So obviously we can do our own thing, but it is helpful to get your thoughts. And we understand it may shift when you go out a couple of years, but just what are you trying to do? And when it does go off, explain why, and we move on.
Yeah, I mean, I think that's, like, I have heard plenty of times that folks are afraid, don't want to do it because what if we don't meet it? And that's why, to your point, Kevin, we're looking for the range. We're looking for the best case, the worst case, the medium case. That's how we do it if we're doing it internally, because that's the best way for a rating committee to kind of gauge, is this realistic? Is this not realistic? So, we understand things, no projection is exactly ever going to be right? So we, it's the story along the way that is important.
Yep.
Got it. And we had a writing question while we were talking about Medicaid. So let me just go ahead and throw it out. Any meaningful insights to highlight on Medicaid redetermination impacts in any particular state that you're seeing?
I haven't seen anything specific. I mean, I have noticed that a lot of folks are getting onto the exchanges that are maybe getting off the Medicaid side. So some of the states may be doing a better job of, at least the ones that I've been looking at, getting folks back on. So I haven't seen anything on the operating, like, affecting the performance significantly. I don't know if Kevin or Eva have seen anything.
I have not yet read in a Fitch report, the rating downgrade was based on Medicaid redetermination, nothing along those lines. I will say there's a couple of health plans out there, specifically in the children's space, where they had a very heavy Medicaid grouping that was high, quite frankly, during the public health emergency, and that's really come down. And so we've seen some health plans with that scenario struggling quite a bit. But general hospital without a health plan really just have not seen major impact. Certainly it's not helping, it's not great, but I just don't think we've ever seen it drive a rating change or even an outlook change, quite frankly.
Yeah, I think there was a lot of good communication about this, as so I feel like systems we talked to had a handle on what was going to happen and how to deal with it. That was good.
Okay. And then one last question on performance. that I have, what are we seeing on covenant adherence? Have you seen an increase in covenant violations? Is it calming down since, more difficult times?
I
Eva,
think
do you want to
so.
go ahead,
No,
Susie?
sorry, go ahead, Eva.
Oh yeah, calming down, but there's, just as with the performance, we have a subsection of, a small percent that are just in constant violation and still very much struggling on the performance front and cash front. So I think, the instances are fewer and farther between, but the ones that there are just recurring issues for some entities, and that is tough from a rating and credit perspective, yes, but overall much better.
And I think that's right. It seems they're more focused in, the lower rated credits and spec grade, that area versus before where it was like, something was popping up at an A or a double A. That's not happening.
Yeah, I agree. Just make it universal. I think certainly calming down was the phrase we used. I agree with that. In particular, MTI debt covenants seems to be settled down a lot. If there's any issues, I think we're seeing it's more like bank debt, if you will, lines of credit, things along those lines are often quarterly tested and maybe just a little bit more onerous, quite frankly. But I think generally speaking, we've seen a willingness of both sides to come together and extend the waivers, work something out, take a haircut here, do that, and again, I haven't seen any us write up any defaults yet or anything along those lines because of covenant violations. They really does seem to settle down in general.
Yeah, I mean, I think also like one spin-off from this conversation is, rewriting covenants in your bank documents and your MTIs. Like we've seen a lot of those reopen and clarify, which I think is a positive outcome from this, experience of the last couple of years. And, yeah.
I guess I'm curious, how have you seen balance sheets? Are they strengthening, or do you have a sense for how? I know we've all relied on balance sheets to get us through, a very difficult period of time. Are you seeing those improve, or are they still sort of carrying a lot of the load? What's your sense on that?
Yeah, I could jump in real quick. So I talked about days cash on hand, which is more liquidity, but obviously it's related to the balance sheet. It's days cash on hand about level, I think, when we run our medians and finally get them out the door. They're coming, I promise. We'll see it about 220 or so. But the big number that we look at, and I often hate to say this publicly, but if you had to boil criteria down to one measure for Fitch, the number one measure we look at is like cash to debt, and cash to debt actually is up significantly year over year. It should end up about 170% as the overall median, and that does, Robert, provide a lot of cushion and a lot of runway for a sector. And we've said there's for all of us, there's a portion of our portfolio that's still struggling, and often they do still have some good balance sheets, and that's buying them some time to make that final turn and the turnaround. So balance sheets are still a strength and a highlight of the sector, quite frankly.
I'd agree they're still strong, but I do think they're not growing at the rate that they were before, and so seeing that cash flow start to get better would be, that'll help, as time goes on. And we're seeing obviously like a lot more debt issuance now. So what does that do over time?
Yeah. Holding is kind of what I would say.
Okay, so maybe a corollary to that, and sort of return now to capital spending and debt a little bit more. Kevin, how would you gauge capital spending overall compared to pre-COVID levels, or sort of what you've seen in the last several years?
Yeah, anecdotally, if you'd asked me this, I'd have said, yeah, it's still not back, kind of a thing. But then 24 hit, and we've been very busy issuing bonds and ratings. And I'll throw out just a couple of numbers for you. So again, medians are not done yet, but it looks like we'll be about 113% spending towards compared to depreciation in 23. And that's compared to a low of 100% in 2021, which is like the first full year of COVID, if you will. It's a little bit lighter than kind of our historic norm, which is about 115 to 120%. So a little bit lighter than that, but I guess it's generally bounced back. Look, this is a high demand for capital. We love borrowing, and we need to in this space, and we've had some pent up demand. And I think those have been addressed or are being addressed certainly in 2024. I do think there'll be kind of a pause right around the election period. It'll be kind of go quiet for a period of time. But if this is any indication of what the next couple of years look like, there's still some pent-up demand. I think we're getting pretty close to pre-COVID levels. Yeah.
Yeah, that's helpful. Even I know we've all experienced an uptick in the amount of debt issuance. I guess curious from your vantage point, are you seeing more kinds of debt issued, more floating, more intermediate term put bonds and the like? How would you characterize that?
Was that to me? Sorry, I missed.
Yes.
Yes. Yeah, I think, I agree with Kevin. The spigot has opened. It's not like a crazy flow, we're not
Right.
drinking from a fire hose here, but it's opened, and totally mixed. And it really depends on capital structure in terms of what we're seeing. We're not in an only fixed environment. Folks are certainly kind of taking advantage of the flexibility of variable rate debt, but it's not, just one or the other here. And, I would say like earlier in the year, and I can't remember if we talked about this at the last one, but like there was a spate of new CP programs that we saw. And I think, so that was one trend that we've seen emerge in the last year, but mostly kind of as a replacement for bank debt or loans. Yeah.
So there was a period of time where the dominant theme was to issue fixed rate debt. Now that's sort of become a more of a mixed bag, and you see intermediate and short-term structures. Does that cause you, and this is maybe for the group, does that cause you to any concerns about sort of an uptick in risk embedded in the balance sheet or in the debt capital structure, or do you feel like organizations have sort of stocked up on fixed rate debt, and so there's maybe room for a little more capital structure risk, for lack of a better term?
I think it depends. Yeah.
Oh, go ahead.
Go. You.
Our favorite word, it depends on the credit probably, and how much liquidity is there and how much, they have to, if they have to refinance more frequently. The sophisticated credits, I think, can manage that. So just wanting to understand, is that how much treasure, if it's a complete shift, right? Like just you have the structure to kind of manage it all, and the flexibility, financial flexibility.
Okay.
Agreed.
So the question for you, are you seeing more kinds of non-traditional leverage, right? So lease structures, concessions. I think, we see a lot of things come across our desk which are debt-like, but not MTI debt per se. And I guess I'm curious how you would, what are you seeing?
Yeah, everyone's keeping us on our toes, I feel like, with all these fun structures that are coming up. So yeah, no, I think we're looking at different kind of lease structures. We've definitely seen the energy types of structures, and we look at all those documents. But they are, on the back. They may not be on the debt per se, but they're a liability, and we kind of think of it that way. So even though it may not sit specifically on that debt line, it is a liability that we consider in our credit analysis. And so, but we have seen a lot of these different types of structures in order to maybe go away from either not use your own cash or kind of go away from sort of the traditional debt structures.
Yeah, we always say here, they may not be on balance sheet, but they're definitely on credit.
Right.
So,
well, and
exactly.
so is that,
know about them.
And that's that's the sort of cash to comprehensive debt, right? So there's cash to MTI debt, and then there's a little bit bigger picture view, I guess. Do those sorts of structures make their way into that calculation in your mind?
Yes.
Oh yeah.
Absolutely.
Yes.
Yeah.
Yes.
And
if it's a promise to pay, it's a promise to pay, right? And you owe it, and hence it's a debt on some level. Absolutely. Yeah. Whether we call it comprehensive or adjusted or whatever, it's debt. Yeah.
And we also try to find out if there are other reasons for doing something like this, because we're kind of considering it on credit. So, and sometimes there are, like, it's lower cost, there's something more flexible about it, and that makes sense. So, giving us that information is helpful too.
And telling us your risk management kind of approach to it is also helpful.
Interesting.
Yeah.
Okay.
Robert, that actually brings us to another writing question, just given newfangled debt structures, everything we've learned coming out of the pandemic. One of our viewers is asking, will you be updating or changing your methodology and how you evaluate credit? Good way to maybe end where we started today. Anyone want to take that first?
I'd venture to say we would all say our methodologies are our methodologies today, and that's as they are. I think we all are regulatorily required to look at them and evaluate them at least annually, and so that is certainly something we do, and we always have conversations around the evolving landscape, and what does it mean for credit, and typically we'll try to, if it's doesn't warrant a full methodology update, we'll at least try to put some research out there to say, hey, this is what we're seeing and this is how we think it flows in the credit landscape.
Yeah, I think there's a lot of, I think we have a lot of flexibility within the criteria to kind of incorporate some of the changing things. So even if we don't have a significant change, we can still pull it into our analysis.
Yeah.
Yep. Same answer really across the board. I think we'd all love the flexibility to change criteria on the fly when we see something new and neat, but the reality is that's just not how it's done. It's got to go through a process and back testing and out for public comment, and what kind of impact does it have. And so you don't do that lightly, and nor do you do it frequently, quite frankly. And so I think Susie's spot on. We try to intend to build in flexibility that we can do that as much as we can, meaning incorporate new unique structures or things along that lines with our existing. So yeah, I'd love to change it all the time, but the reality is it's just not going to happen. Yeah.
You'll need to clone yourself if you're going to do that.
Right.
Exactly. Find more than 24 hours in the day. So yeah.
Mm-hmm.
So I'm curious, what are common questions you get from investors?
I think I'll just go because I think we've all said it throughout the conversation, but like, is this sustainable? Is this model sustainable? And, where is this going from here is like the one that we've just been getting in recent calls.
Yeah.
Yeah. If you're on a negative outlook, it's always, is it going to go down? And we love when we get those questions.
And of course, how much runway do I have? Yeah, and Robert, to your other questions, like if I do this, am I going to get downgraded, or if they do that, will you downgrade so and so? So we get those questions quite a bit. I would say that the interest level, I think, from investors has never been stronger, quite frankly. And the phone rings a whole lot more, and asking very good, very solid questions. And I can remember when I first started this business, I'd occasionally get phone calls like, is AA a good rating? Like, yeah, that's pretty good. But now it's like, have you read page 47 of the audit and this little bullet point there? I mean, they're really, really on point on these things, and I think that's good and healthy for our community, quite frankly.
Agreed.
Yeah. And I also that was a great summary response or ending response, but I'm just going to throw in, we did kudos to you all for the direct payment supplemental program and 340B questions, because we do get a lot of those from investors too. And sometimes, if you think we're being weird asking you for extra details, it's because investors are asking us, and we're trying to incorporate that into our, write-up.
Yep.
That's a good point. Yeah.
Well, we have more questions, but we don't have more time. And so maybe what we'll do is in a second, I'll turn it back over to Jim to wrap it up. But I just want to conclude by saying thank you again. These conversations are always insightful and illuminating, and to get from you directly your thoughts and your impressions of this are just invaluable to our clients. And so we thank you for taking the time to do that. Maybe Jim, with that, I'll turn it back over to you.
So thanks, Robert, and thanks again to our panelists. So as a reminder, you'll be receiving a link to a recording of this webinar within the next day or two. Thank you for joining us, and have a great rest of your day.
Great. Thank you all.
Everyone.
Thank you.
Have a good day.
Thank you.